where you sit at a booth and nobody comes and talks to you. Y'all go out and visit with these folks. You'd be surprised what you can learn from these professionals. Next on the agenda, we have Derrell Peel. He's Extension Livestock Marketing Specialist from OSU. He's going to enlighten us on lessons learned from 2015 versus 2023 market and business outlook. Derrell?
I'm going to be wandering around the edge of your table here. And I was told there was a slide changer up here, which I do not see. Bruce, I don't want to tell you you lied to me, but somebody lied to me. There's one in my bag if you need one. All right. Come on. All righty. Well, actually, this is a great setup. I really appreciated following him because so much of what I have to talk to you about follows from his forecast, and I usually wind up trying to summarize what I hear these guys saying. So this is a great way to start this thing. So now I don't have slides either. That's okay. We'll get a chalkboard up here maybe. Okay. So I've been at Oklahoma State now for nearly 34 years. Thank you. It's not yet. There it goes. I just need to be a little bit farther back here. From right here. That's right. I'm going to wander around in here anyway, and I'll try to move because I'm big enough that I'm going to block somebody at all times, but I'll try to share the pain a little bit. So I was going to say that I was born right up the road here in Muleshoe. This is where I grew up. That's not near Muleshoe, in case you don't recognize that. I actually grew up, my dad was one of those row crop farmers in West Texas, and he wanted out of that when I was a little tyke. So we moved all the way to western Montana, about 100 miles south of the Canadian border. And so it was a very different environment. He wanted someplace where the hunting and fishing was a lot closer than it was to Muleshoe. So that's where I ended up. We'll see if this thing's going to work or not. It's not being very reliable. There it goes. All right. So we got quite a bit of ground to cover, but I'll go through some of it pretty fast. The broad outline is here. I got to talk about drought, so we're going to follow up what Brian said and talk about, the first line there is continuing. He's already kind of addressed that, so I don't have to try to. We've had cumulative impacts, which I will go over, of how we got to this point, and what it sets up for where we go from here. Cattle prices are trending up, and we're going to talk about that. They will continue to trend up. And can you change for me? Okay. Back it up for just a second. I was almost ready, not quite. I'll talk a little bit about demand, the big picture stuff, before we get into kind of the details of the cattle herd and all of that. Obviously, you're dealing a tremendous amount with input price issues, cost of production issues. I won't say a huge amount about it. I will talk a little bit about some of it, but that's obviously a big part of what you're there, and I recognize that. And so, when we talk about prices being higher, then we have to also consider that cost side relative to, what it means for real profitability prospects, which is sometimes a different story. So next. So just quickly, we got annual inventory numbers from USDA last week. So these are pretty new. These are the top 10 in the list. I create several of these just to kind of summarize where we are. And if you look at those percentages in brackets on each one of these, tells you what happens in these individual states. So Texas all cattle and calves were down 2%. Nebraska was down. Kansas was down. Oklahoma was down quite a bit, 11%, and so on. Most of these top 10 states had less cattle now than they did a year ago. Cattle on feed numbers are beginning to come down. We'll talk about that. Texas and Nebraska are actually tied right now in terms of cattle on feed numbers. Next. Beef cows, top 10 states again. Texas it was down about 3%. Oklahoma was down almost 7% as the number 2 state. If we keep dropping and Missouri doesn't, they're going to pass us again and be number 2 again. A little bit close. Got it? All righty. And so you can see the other top 10 states again. Almost all of those, with the exception of Missouri, were down on a year-over-year basis. Beef heifers, Texas, Oklahoma, South Dakota, Nebraska, so on. Nebraska was down 9% in terms of beef heifers, and so you really see that. Missouri was actually up. They were in somewhat better shape going forward. So anyway, you can see those. And the last one here, feeder supplies. So this is a calculated number. We don't measure stockers in this country, or in our data system in this country, I should say. I've been in Oklahoma over 30 years. I still don't know how many stocker cattle we produce every year because we don't measure them. But we do take the inventory categories and back out a residual number that we call estimated feeder supply. It's as close as we can get. And again, now Texas was actually up, and I'm not positive I have a great story to tell about that. Oklahoma, on the other hand, number 3 here, was down almost 19% in terms of this estimated feeder supply. I can tell you that I've been around Oklahoma quite a bit in the last few days. We normally have a lot of cattle on wheat this time of the year. We don't have very many cattle on wheat through most of the major wheat areas in the state. There's a little bit in the western and the southern part of the state, but frankly, I saw more calves under circles coming down here from Amarillo than I've seen anywhere else all winter. So, and I wouldn't even say that you have huge numbers, but it's the most I've seen. So let's get into some of this. There it goes. Okay, hang on. Now I'm going too fast. I'll get the time lag figured out in here maybe eventually. So kind of what's the setup in a very big picture sense when we start? 2 lines here. That dotted line is the all cattle inventory, so those same numbers for the whole U.S. And again, just to highlight, and we'll see this several times in different forms, 2014 was a low. 2019 was the peak. We started getting a little bit smaller after that, but of course with the drought the last 2 years, we've accelerated that liquidation down significantly. At the same time, the red line is total beef production. It bottomed a year later than cattle inventories, and we'll talk about that timing. That becomes very important. It's again part of what Brian was talking about, and then some of the questions relative to the timing of some things. We should have peaked from a cattle numbers. We should have peaked. Cattle numbers peaked in 2019, I should say. Beef production should have peaked in 2020 or 2021. Now the pandemic caused a lot of changes in timing, so we pushed it from 2020 into 2021 for sure. Should have been the peak, kind of flattened out for 1 year, and the last 2 years it's gone up. 2022 beef production on the far right-hand side of this thing is an all-time record beef production in the U.S. What's important here is we got that the last 2 years because we're eating inventory. Okay, drought forces you to eat cattle. You can do that for a while, but you can't do it indefinitely. And it has long-term implications when you're eating inventory, and that's what we've been doing. So just a quick rundown of markets. I'll do this really fast. Calves, dotted line is 2021, blue line 2022, green line so far this year. We've been going up since the lows in 2020 for calf prices, feeder cattle prices, fed cattle prices, across the board. That trend's been in place. We've been seeing some increases in prices. We expect that to continue. That's a spoiler alert for the end of the thing here, but in general, we have seen these markets start to trend up, even though I would say that we haven't really had all pieces of the industry kind of on the same page. We're about to get there, I think. We're in the process of that. We look at wholesale beef prices, 2021, the dotted line, we had tremendous beef demand in 2021. I think a bunch of that was pent-up demand coming out of the pandemic. We had a lot of folks who had money, they hadn't been anywhere, they hadn't traveled, restaurants had been closed. When they started opening up, we had tremendous short-term beef demand in response to that. It kind of worked its way out by the end of the year, and the blue line was last year. Still very high prices, relatively speaking. Beef demand has been strong continuously throughout this process, not just as measured here, but in total, all the considerations. The one thing that's different is we had probably the flattest price structure for wholesale beef last year that I've ever seen. Relatively little seasonality. That tells me that we do probably have some issues going on within the beef demand complex relative to higher prices, inflation, high fuel prices, other things that consumers are dealing with. So I think we still got to watch it, but it's very much a case of sort of so far so good. We've got lots of concerns about what could happen, but frankly, those have not materialized over the last couple of years, even though we've been watching for it continuously. The green line is box beef prices so far this year, starting out in that same range at this point in time. My leash is a little shorter than I realized, I think. There it goes. Finally, cull cow prices. Last year was a really, in contrast to box beef, cull cow markets, I've never seen them more volatile than they were last year, but generally at higher levels. And that's all the more, impressive when we get to the slaughter numbers. We'll talk about them a little bit later. But you all know that we liquidated a lot of cows last year. And despite that, we had very strong markets. Again, part of that was that demand complex. We had very strong lean beef prices driven by the ground beef market. And the green stuff over there on the left-hand side is where we're starting out this year. In Oklahoma last week, these lean cows they would jump up off this chart. They were actually 83 and change. I don't have this chart, and that was just Oklahoma. This is a little bit broader average. But the point is this market is strengthening pretty rapidly this spring. It normally is seasonally high going through March into April and maybe even May for these cull cows. Okay, a lot of numbers here, but the bottom line, beef, the line that says beef, again, last year was record level beef production for 2022. The green section of this table is current forecast for 2023. They will change, forecasts always do, whether it's weather or economics or anything else. At this moment, we're looking at a 4 to 5% decrease in beef production in 2023. Okay, and I'll get to the story of why that has to happen. In fact, that's probably a minimal level. It could be bigger than that as we go forward, and it's going to continue down for the foreseeable future. Pork industry is kind of stabilizing. They actually had been down last year. So we'll have, kind of stable supplies of pork. Broilers, again, relatively stable. They grew some last year. Total meat supplies, that bottom line, this year will be the first time in about 7 or 8 years that thing has decreased in the U.S. Okay, so, and that's almost all on the backs of the decrease in beef production. Retail beef prices, in 2022, you can see we're, again, very stable. When you think about all the challenges, and you think about the fact that we had record production, and I'm going to show you that per capita consumption was higher last year, and yet we had very stable prices. That's my definition of strong demand. And so going forward, again, we're watching it. There's certainly a lot of things could go wrong, but it hasn't yet, and that's a great thing. It's quite dry out here too, by the way, in all senses of the word. These are the ratios of the retail price series across the three major meats. So the blue line is the ratio of retail beef prices to retail chicken prices, broiler prices. And what you'll see on the far right-hand side is that beef actually got cheaper relative to chicken last year. And that's probably helped us somewhat with beef demand. I talk occasionally to some food service people in particular. There was more concern about, thank you, there was more concern about rising chicken prices last year than there was about beef or pork, either one, right? And you can see that. Well, no, you can't. There you can see it. You know, the ratio of beef to chicken prices is actually about the lowest now that it's been in a decade. So that's good. I don't know that that will last. The chicken market kind of melted down at the end of the year. So these things may change a little bit, but that probably was supportive in the short run. Beef to pork didn't change a great deal, but pork prices were actually a little stronger. That's the green line. And, that's the red line. And it dropped just slightly on that. There's per capita beef consumption. In the short term here, peaked in 2022. It will be lower in 2023 and 24, and perhaps beyond that. We have to wait and see. You know, now I usually put this chart up before I talk about prices and ask people whether that means beef demand is getting weaker. It doesn't mean that. Per capita beef consumption is going to go down in 2023 because we're not going to produce as much beef. You can't eat the dang stuff if you don't have it. All right, so that's just a measure of supply, really, by itself. But when you look at it in conjunction with prices, then it starts to tell you something about beef demand. And I'm not sure whether I'm doing this or this is just my way of telling you when to click for me. Okay, beef exports. I got to do a little bit of this, and then we'll get into really the more nuts and bolts that affects you. This all affects you, maybe more directly than you realize, but in terms of the drought and the herd stuff that we're going to talk about. So these numbers came out, the final numbers for 2022 came out this morning. So on the far right-hand side, the total for 2022 for beef exports was actually a little higher than 2021. It is a new record for both quantity, which is here, as well as value. And so that's part of that demand picture that's very supportive. We have seen strong exports the last 2 years that continue to help us in terms of that total beef demand. Next. Part of that was China, Hong Kong. Back up for just a second, would you? If you look at, compared to previous years, the yellow section of that bar, that column, is China, Hong Kong. You can see that it has been the fastest growing part of that bar. Next slide. And you can see why. After we got official access to China a few years ago, starting in 2020, it really started to take off. I put the data for China and Hong Kong together because they still come separately, but they're not really separate markets anymore. And in fact, you can't understand the market in total if you don't add them together. And so what you see, as we sort of expected, Hong Kong by itself has gone down over time, but China has increased so much. They are our number 3 market, and growing at a pace, at least they have been growing at a pace that would suggest they would be our biggest market relatively soon. However, this latest data did show a significant drop-off in December. And I haven't had time to even look at it or fully analyze things. It came out about 11 o'clock this morning, so I'm not sure what that means. We knew there were some headwinds. We've had a strong dollar. And of course, we've got lots of issues outside of beef markets between the U.S. and China, so that may all be part of it. I don't know. Next. Beef imports haven't really changed a whole lot. They were up just a tick in 2022. Canada's currently our biggest source. Australia, New Zealand. Australia historically was our biggest source. Hasn't been in recent years. They've had lots of drought issues. Their herd's been down, basically. They've been a little bit out of the market. They are rebuilding. They'll be back a little stronger at some point. Maybe not this year. But at any rate, we import beef. Next slide. Most of what we import is in these, and the 4 left-hand bars are our biggest sources there. That red portion of all of those bars is trimmings, processing beef. It's stuff that goes into ground beef. And it's what supports our tremendous ground beef market in this country. It's basically the way we utilize all of the the fatty trimmings we get off of our fed steers and heifers to turn them into ground beef so we can sell it as hamburger, and that's where most of that is for the most part. Next slide. Cattle trade in North America, we got significantly less cattle from Mexico last year, and the percentage, I don't know, I didn't get a chance to calculate it actually. Next slide. We actually export a few more cattle from Mexico than we used to. So on the very right-hand side of this, you see the blue part is imports directly. That's at the lowest level, going back to about 2008 or 9. And when you net out the cattle we export to them, you clearly take it down to that 2008 low. So we're not seeing as much of that live cattle trade with Mexico in terms of the imports. We probably won't, because in fact, their infrastructure for feeding and processing cattle has continued to expand such that they'll probably just keep and utilize more of their own cattle in that sense. Now, obviously, they are one of our growing sources of imports. That's kind of the situation. They either come live or they come as beef to the extent that that's what fits into the market situation. Next slide. Canada quickly, cattle imports they're up slightly for the year, but not so, mostly in the first half of the year. Next slide. We actually export some cattle to Canada. I was actually in Ontario about 3 weeks ago to their Cattle Feeders Association annual meeting, got to visit some of their feedlots up there. I started to put a picture in, but we don't have time for a travel log. All the feedlots up there are inside, fully enclosed. Very interesting part of the industry and the way it works. Next. Okay, now transition to the story that follows really closely from what Brian was talking about. This is the latest drought map. So you can see it matches up with some of the information he had. We still have a lot of drought, particularly in the central and southern plains right now, but there's a lot of dryness generally in the west. Next slide. If you go back to last fall, there was even more dryness around the country, but these same areas obviously were impacted much more, of course, in California back then. They've had rains, including too much rain in some cases in the last month or so. Next slide. Back up to July of 2021. This area, or from here west anyway, in the southwest, horribly dry conditions. A lot of drought in the northern plains in 2021. North and South Dakota, Montana, areas that do have a lot of beef cows. And I say that it's just a fact of life. New Mexico on its best days just doesn't have many cows, right? It's just the nature of the country. It was a big impact. But in terms of national market impacts, it's a much bigger deal when you get into the middle of the country where concentrations of cows are much higher. So 2021, it was more in the northern plains. 2022, we just saw is in the central and southern plains. Back up one more. As Gary said, or next slide, please. It started in 2020. This shows the summertime in 2020. Again, you had a lot of issues in the southern Rocky Mountains areas and southern plains a little bit. And that's when the drought really started. Next slide. So out of those drought maps, there's a thing that's calculated in there that most people don't see, but it's based on those drought categories. It's called the Drought Severity and Coverage Index, and it's a nice way to translate those maps into a single number. And if you look at this thing, it's plotted for the whole U.S. Here. You can plot it for different regions, states, whatever. But for the whole U.S., there's a black line there on 150 index value. Now, without going into detail, this thing can go from 0 to 500, but for the whole U.S., if it's 150 or higher, that's a very serious drought. It's more than one standard deviation above the average. And what you can see is that since October of 2020, we have been in that continuously until about 4 weeks ago. We had 118 consecutive weeks where this index was above 150. That's a lot of drought, that's a cumulative drought, and a lot of impacts. Now, if you look back across there, there's only been a handful of times in the past that we've been above that. In fact, half of all the times we've ever been above it have happened since the end of 2020. But you notice that big spike, actually the highest it ever got was about a decade ago in that drought. Next slide. This is what the map looked like in the middle of July in 2011. You all remember it. It was extremely severe drought in this part of the world. One of the differences between the situation now is that it was contained regionally. I won't say it was small, because it was a pretty big area, and certainly a big area with respect to the cattle market, but it didn't cover a lot of the country. And what that meant was we had more access to hay that could be brought in from other places in that year than we do now. We had more places we could ship cows to if that worked out to be an answer for some people. Most of those are less of an option in the current drought than they were then. Next slide. 2012, much more widespread. 2012 was actually when that all-time peak in that index, that DSCI index, happened. Next slide. 2013, kind of back in this area again. Still some drought, starting to move in from the east, some better conditions as Brian talked about. And so, you know, going into 2014 into 15, then we saw some improvement in conditions. Next. So, where are we at now? 2022 hay production, all-time record low on this data series. Back to the mid-70s. You can see the spike down in 2012. We went lower than that this year. Next slide. Hay stocks, December 1st, also a record low for the data series. There's not any hay anywhere. I just came back from a road trip in Iowa last week. You know, they don't have a lot of cows left because they planted everything to corn and beans a decade ago or 15 years ago. But they try to get by on corn stalks and things like that. And they said that we can't get our corn stalks because they're all on trucks rolled up and they're heading south. That kind of thing. Next. If you look at that December hay stocks number, you know, where was it down? Well, not surprisingly, where you would expect, in the middle of the country. Those are percent changes in December 1 hay stocks, mostly in the center part of the country, a little bit in the southeast as well. Next. So hay prices are record level. Not news, but I guess what it means is that if you're still thinking or still having to think about what am I going to do if I'm not quite positioned right for the rest of the winter, there's no alternatives that really are good. That's the bottom line. You probably know that already, but it's not like we can look a lot of places, turn over some rocks we haven't looked under yet. There's just not a lot of hay stocks to work with. Next. Corn prices are high. Again, 2021, 2022. So far in 2023. Next. The difference in the feed markets, and there are sometimes in a drought when we can use something other than hay to try to get through a drought. There's no real good feed alternative of any kind, this market, but the difference is that the corn market and feed market or grains market situation basically is not a matter of drought. Corn prices are high. Not because we had a bad crop. It was down a little bit last year, the second to the right-hand bar, but not a bad crop by historical standards. Last time we had corn prices kind of like this was 2012. That was a drought-caused, supply-caused corn market. It's not that now. It's based on demand, exports, continued industrial use, read as ethanol, and so on. So that market is there. Next slide. You can see the uses there. Next slide. The key to this is ending stocks. That's how market prices really get determined. The market tries to make sure, more than anything else, that we don't run out of stuff. So we got fixed stocks of corn. We've got corn ending stocks projected for this year at around 1.2 billion bushels. That's not like we're out of corn, but we've got nearly $7 corn, and it's more like close to 8 in the southern plains because, you know, we want to make sure we don't run out. It's a long ways from now till the next harvest, okay? Now, the far right-hand side is a current projection. We could see some relief in ending stocks, at least get above 1.5 billion bushels. That would pull corn prices down a bit. It's a long ways out, and that's just pure speculation at this point relative to what this next growing season is going to be like. And what we might see for production there. Next. What that translates into, the higher corn prices the last couple of years. No, the next one. Kansas feedlot cost of gain. The dotted line is where we started. Well, look at the left side. We started 2021 with a feedlot cost of gain about 82 or 83 cents for steers. By the end of 2021, it was up around $1.05 to $1.10. By the end of last year, we got data through November here, we're up over $1.35, pushing $1.40 for steer cost of gain, add a dime on for heifers. And given what we just said about the corn market, I don't see that changing appreciably, at least not till this coming harvest, through the rest of this crop year. Okay, so there's no real relief there. And obviously that, and then, you know, some of this corn gets used for supplemental feeds, and all of the things that follow corn affects you more directly maybe, but this affects you in terms of the feedlot situation and what those guys are going through from a standpoint of their cost of gain. Next. Next. Okay, cattle inventories, lots of numbers here, but just read down the far right-hand column. All cattle and calves down, beef cows down 3.6%. That number for beef cows is slightly lower than the 2014 low, not by a huge amount, but it did come out a little bit lower, and that makes this current beef cow herd the smallest since 1962. We're smaller than we need to be. Dairy cows haven't changed. Beef replacement heifers. I put out pre-report estimates. There's only a handful of us that do it for this report. I put 5 in there, thinking I was probably too pessimistic. I was by far the biggest estimate for what how much heifers would be down. They came in nearly 6% down. Okay. Out of that number, and I don't have it on here, but out of that number, USDA says about the number of heifers, bred heifers that are out there that can calve this year is down about 5.1%. That's part of that heifer replacement number, right? It includes bred heifers that are going to calve this year, plus heifers that we're going to breed this year to calve next year. The heifers that'll calve this year are down 5.1%. The residual heifer calves that you calculate out of this would be down nearly 8%, or 7%, excuse me, 6.7 or 9 or something. Feeder supply down 2.6%. Cattle on feed down 3.7. Last year's calf crop down nearly 2% again. And all of these are coming down from 2019. The calf crop actually peaked in 2018, leading to the January 1, 2019 peaks in all these inventory categories. Next. So you can see it graphically here. Again, it's not real obvious, but the current low on the far right-hand side goes all the way back to 1962 to actually be this low by a little bit. Now you remember, obviously, 2014, we came out of that. The weather conditions changed, as Brian described. We rebuilt the herd. We needed to, because that was smaller than we needed to be then. We're smaller than we need to be now, and there will be rebuilding going on as soon as we can. Next. There's the heifers. Again, graphically, you can see how much they're down. You know, they actually peaked in 2017 in the midst of the expansion. We had the most recent peak in heifer numbers as we were in the process of rebuilding the herd. It's a long ways from that number down to where we are now. Think about getting back to that with the stock of heifers we have available. Next. Feeder supplies down. Next. Most of the feeder cattle, this is more of a long-term structural thing, but just for your curiosity, most of the feeder cattle that we calculate are actually in the southern plains. That's Kansas, Oklahoma, and Texas at this time of the year. And this is still true. It didn't really change the percentage this year, even though we have fewer cattle on wheat than we normally do. Next. Not that next. That next. There's a long story about feedlot inventories last year that relates to how long I was wrong. I started the year last year saying feedlot inventories had to come down. And by the end of the year, my goal in life was to live long enough for them to come down so I could be right. But they did finally come down. The drought forced us to move calves into the feedlots earlier than usual. That pushed the numbers up. We'll see in just a minute that heifers played a big part in that. But by October of last year, the blue line finally dropped below the dotted line. And by the end of the year, and then January 1 of this year, we're down about 3% on these monthly cattle on feed numbers. Next. In January 1 of this year, heifers made up 39.8%, I think it was, 39 point something percent of all the cattle in feedlots. That was the highest heifer percentage of feedlot inventories since 2001. Okay, there'll be more to that story coming up. The reason feedlot inventory stayed higher longer was, again, due to drought movement of cattle generally, early, as well as these heifers. Next. So, on the far right-hand side, you can see the seasonality that normally exists in the feedlot industry. We peak in December, January, or February usually. We go down into a summer low and then rebuild it in the fall when both calves and yearlings come to town. You can see what happened this year. That feedlot inventory actually peaked in November. It was lower in December. That's very rare. It was higher than December in January, but still lower than November. That looks like it is the seasonal peak. So you can see where we go from here as we pull them down seasonally into the summer. Okay, bottom line is this thing's going to tighten up a whole bunch. It's going to be much more obvious this year than last year just how tight cattle supplies are. Next. Cattle slaughter. Heifers last year, go to the second line. Heifers were up 4.8% for the whole year, year over year, on top of a 4% increase the previous year. Jump down to beef cows, up 10.9% last year, year over year, on top of 9% increase the previous year. Sum of all that, next slide. In 2022, on the far right-hand side, 51.4% of all the cattle we slaughtered in this country were female, heifers and cows. And you can see from that chart that has not happened since 1986. It's only happened a handful of times ever. Even in 2011 and 12, when we were liquidating, we did not get this high. Okay, next. The culling rate, if you just take the beef cow slaughter part of that as a percent of the beef cow herd, we ended up the year with a net culling rate of a little over 13%. It's never been that high. That's a new record. A decade ago, it got a little over 12%, but we culled, effectively net culled, more beef cows last year than. Now the data goes back to 1986 for that breakout, but it's never been that high. Next. So, you've seen this before. I shaded the expansions of the last 3 cattle cycles. One of them wasn't much of a cycle, but 2014 low to the peak in 2019. Now, Brian, I keep wanting to call him Gary. He's one of the weathermen in Oklahoma. Brian talked about the timing a little bit, and he gave you some indications of timing. It helps me a little bit. It's still not clear, obviously. Maybe it's more clear that it is going to change. How fast it's going to change, I think, is still very much a question for him and for us. But at some point in time, this industry is going to want to rebuild from the lows that we're at. I suspect this year this number that we just got is not necessarily the low. Okay? In fact, before we talk about rebuilding, I'll tell you this. Whatever the drought does this year, based on the way I look at the numbers, I don't think there's any possibility we can actually expand the herd this year. If it starts raining tomorrow and we got all the grass in the world by April and May, it isn't going to matter. The numbers just don't work. The best you could hope for would be to hold the inventory, the cow herd, steady this year or limit it to a very minor liquidation. Okay, so I think that's what we're looking at is the liquidation going to be, 0.25% to 1% more on top of what we've already got. Okay, and in order for that to happen, by the way, beef cow slaughter compared to last year's number has to drop over 20% this year. That's a big number and scary to talk about. I don't think we've ever actually dropped it that much in one year. So it's still kind of a toss-up. But at any rate, at some point in time, we are going to want to rebuild. Whether it's this year, this year probably, if Brian's right, this year sets the stage for this process to start next year, to really begin rebuilding. We save heifer calves this fall, as was mentioned. We're really starting with new crop heifer calves this fall. So think about the timeline on those heifer calves. Grow them out, breed them next year, get a calf the following year, get beef out of them the next year. It's a ways down the road. It's a slower process this time. But how does it happen? Next slide. Two things. The blue line is heifer retention as a percent of the cow herd, so those beef replacement heifers. In 2015 and 16, that shot up to a record level. At the same time, the red line, which is cow culling, we just talked about, dropped to a record low in 2015. I just talked about it might have to drop more than 20% year over year. That's what happens to rebuild the herd from 2014 to 2019. We will do something like that here at some point. It may start in 2023, but I really think it's probably more likely in 2024 to really get it going. Next slide. When you save all those heifers and you don't cull all those cows, you get the 2015 spike down in total cattle slaughter, which was the lowest level since 1963 for 1 year. Again, probably doesn't do that this year. It's probably next year, possibly even beyond, depending on the timing of things. But it will happen at some point. Obviously, that has big implications for beef production. Next slide. Here's a plot of annual average prices, taking out all the short-term things, all the seasonal things. We got calf prices, feeder cattle prices, and fed cattle prices. Far right-hand side, you see current forecasts going forward. The trend that we've been seeing continues. Okay, and I'm comfortable with that. We keep tweaking it slightly, but hasn't changed a great deal in quite a few months now in terms of the idea that we're going to see generally higher cattle prices through this time frame and very likely beyond. Now, I got to tell you something. That spike up in 2014 and 2015, well, two things about that. One is, if we're going to do something like that again. Next slide. Might as well put it up there. Somewhere in here, those general trends up in prices aren't going to be enough. We're going to spike up for some period of time when we can try to rebuild, and we'll do it again. Now, the story I was going to tell you was we had never seen anything like 2014 and 15 when it happened, and I was completely wrong on how fast you guys could turn that around. Okay? Now, I'm fairly convinced that the situation's a little bit different and it will last a little longer this time, but I have learned my lesson. I will not underestimate how creative you guys are to respond to incentives when they're there. Okay, so we're going to get 2 to 3 years of this expansion-driven spike up in prices here at some point in time. Now, you got two questions. When? Well, I just told you, I don't know, although I feel a little better now than I did 2 hours ago having listened to Brian. Okay, but we're not sure exactly the timing of that. How high are they going to go? You know, I've been an analyst for 30-something years, and the reason I'm still around is because I learned a long time ago not to give you a price and a date in the same sentence. Okay? It's a humbling profession on the best of days. But the bottom line is we will go higher than 2014 and 15. We may go significantly higher because your cost of production is higher. You're going to have a true profit incentive to expand, not just high prices. I'm too scared to actually say a number. I'm thinking one, but I'm not saying it. I can't bring myself quite yet. I need to be a little farther down the road, but it's going to be a ride. Now, you remember the first part of that was kind of fun if you're a cow-calf guy. The back half was a little bit of a hangover. So keep that in mind. Keep in mind that heifer and cow prices are going to go through the roof again, like they did last time. All of those things need to be considered. The thing you can do different is we see it coming. Maybe we didn't see it as well the last time. You can make some plans and figure out what you can do specifically to try to be prepared as much as you can to take advantage of it, or maybe to not get caught up in some of the whirlwind that caught some people last time in terms of the backside of this thing. Next slide. So we started with this graph, except I've extended the production line to show you that beef production is going to drop sharply in the next 2 to 4 years. Don't know how long for sure, but at least 2 or 3 years we'll see beef production shot. Now, there's an obvious question here. How much higher can consumer prices go? They will go higher because there's not going to be as much beef for the first time in several years. So we are going to ration it. There are going to be some consumers who do get priced out of the market, but we'll sell all the beef. We always do. It's perishable. If we produce it, it'll get sold, and it will get sold, in this case, at higher prices. There's an element of demand that will pay more when they have to. Okay? Some people will probably see more of the thing we've been watching for several months. We talk about consumers trading down from higher cost, higher valued products to more value-based products. We haven't really been able to detect it very well up to this point, but it'll probably become more obvious here in the next few months. Next slide. I think it's, a little bit on prices, a little bit more on prices. I pulled these from yesterday's closes, so some of this is well built into the futures market already. Okay, this doesn't have today's close on it, but yesterday's close. So the nearby March feeder cattle futures is at 187.10. Follow them down. By November, that same March feeder futures contract is yesterday traded for almost 215. So my math is weak up in front of a crowd, but that's $22, $23 increase built into the market already. Now the basis numbers are for Oklahoma. They might not apply here, but in Oklahoma, we're talking about a 4-weight calf in October, come weaning, in the neighborhood of 23 to 24, or 230 to $234 a hundredweight. And if I did the math right earlier, that's like $1,050 for a calf. Now, does that overcome your production cost stuff? I don't know. I suspect we could survey in this room, and there's probably $500 difference from top to bottom in the cost of production in this room. So you can think about that a little bit. Next slide. These are forecasts that are actually put out by the Livestock Marketing Information Center. Lots of numbers there. They will change. Again, they're only valid until I can get to the computer and change them. But the way it reads right now, 2023 annual prices, 12% for calves, 8% more on top of last year's prices for feeders, 8% for fed cattle. 2024, skipping the quarterly numbers, another 11% on calves, 6% on feeder cattle, 9% on fed cattle. That's the way it reads today. Those will change, but I think the downside risk in those numbers is pretty small, all things considered. I think that's the last slide. Go one more. Oh, well, we've said all this. I don't need to say that anymore. Next slide. This is how you find me. I'm not hard to find. If you have any questions or I can do something for you, send me an email. I do write a weekly newsletter with some of my animal science colleagues at OSU. We have for years. If you'd like to get that directly from us, you may see it indirectly. It gets republished quite a few places, but if you'd like to get it promptly every Monday morning, send me an email and say, put me on the newsletter list. We'll be happy to send it to you. We don't sell anything. We don't let anybody who does sell stuff get that list, so it won't generate more of that kind of stuff. It's just a chance for you to get what I'm thinking for the week straight from the horses, well, one end of the horse or the other. Do we have time for questions? Yes. Okay. Questions? Yes, sir.
Related to 2014 when we sold quite a few steer calves. We sold steer calves in 2014 in December weighing close to 500 pounds for $3 a pound, 650s for $2.20 a pound. How does that relate now, considering the inflation that we've had since 2014? The nominal costs you show are similar. What would be the actual cost different, or the values different?
So you're wanting to know what the real price difference is. Well, you got to look at a lot of things to do that, right? Nominal prices for cattle are higher, nominal prices for inputs are higher, so you have to go through that whole exercise. So, you know, what we're talking about is what you're going to see as actual nominal prices at a point in time. But to your point, it's the same thing I said earlier. You've got to see it in terms of real profitability potential. That's what you're going to respond to as a producer. So, you know, I can't tell you exactly, first of all, I can't tell you what inflation's going to do or how it might change over the coming months precisely. But here's what I will say about those kind of prices and the incentives that go with them. Markets work pretty well, in my opinion, most of the time. And to the extent that we need incentives as an industry to get bigger because we're smaller than we need to be, those prices will go to levels that get that done. Notice how I carefully avoided giving you a price and a date in the same sentence. Yes, sir. I need the exercise.
So the Federal Reserve continues to increase interest rates, and if we see a recession in the broader economy, do you think that'll influence this cattle cycle?
You know, so you know, will the potential for a recession is there. That's obviously one of the things that we have been watching, continue to watch. The Federal Reserve's trying to cool the economy down. That's a tricky proposition to avoid doing too much, et cetera, et cetera, et cetera. All of those are things that we continue to watch. We have to watch. You need to watch them. I will certainly be watching them. First and foremost, from a demand standpoint, again, we're, you know, the consumers and all of that, you know, demand is defined as willingness and ability to buy stuff at a certain amount at a certain price. Okay? If you don't have any money, you have no ability, even if you have the willingness. So, you know, obviously we have to watch those things. The other part of it, of course, as you mentioned, is interest rates. That's one more change in cost of production that you guys face. So that's part of the picture as well. You know, what's going to happen? You know, I don't know. I mean, I can't figure out cattle markets, let alone the big economy. I have my thoughts on it, but they're just my thoughts by and large. And so I think the point is you have to keep watching those things. However, I will say this, that when you look at the cattle market fundamentals internally, basically this supply situation that we find ourselves in, it's going to be pretty resilient to an awful lot of stuff. Okay? So we may see tops that are not as high as they would have been without all those things, but they're still going to go up. Other questions, comments? Anybody awake after lunch? Looks like we've done enough damage for one day. I enjoy this conference. I've done it several times. Appreciate it very much, the chance to be here and visit with you again. And it's kind of nice to come back to Lubbock every once in a while, even though I don't live here and haven't for 60 years now.
Thank you, Derrell. Guys, we're scheduled for a break, and I guess we'll be back at 3:15. Y'all go by and talk to these people at the booth.
You're listening to live coverage of the 2023 Southwest Beef Symposium at the Overton Hotel in Lubbock. We're on the farm station, All Ag, all day, online, allagnews.com. Building back if and when is really the topic for the two-day event. We heard earlier from Brian Bledsoe, consultant, chief meteorologist, and climatologist with KKTV News in Colorado.